Everybody who's been a gold bull or a silver bull have been fabulously rewarded in 2025. In fact, over the last 15, 20 years as well. The question is, after such a mammoth rally in 2025, are we looking at an encore in 2026? Could we see a subdued return in 2026? Or could something completely dramatically different happen? Two men who 9 months ago predicted this happening are joining us yet again. Viewers, if you remember, Dr. Edward Yardeni and Naresh Kataria spoke to us 9 months ago and mentioned when gold prices were at $2,950 odd dollars that we might actually see 4,000 by the end of the year. A lot of people may have thought, oh no, they're smoking something, but boy, have they turned out to be true. The advice was prescient. Gentlemen, both of you, thank you so much for joining in yet again on this very important conversation, because for India and arguably for the world now, gold and silver are becoming central holdings in the portfolio. So Dr. Yardeni, you joined us so late, so take a moment to thank you for joining and doing that.
Sure.
But you were amongst the earliest bulls, right? Along with Naresh on gold and silver, way back in starting 2025. Right. And the reasons that both of you had were similar, amongst other things, that central banks are buying. What is your view now?
Well, I think central banks are still buying, but other factors are also playing a role here. I think we're seeing a lot of investors who haven't done so well in 2025 realize that gold has been a more stable place to be. So, for example, Chinese investors that have basically lost a tremendous amount of money in the property market and have been whipsawed in their stock market, I think you're seeing more buying of gold in China. India has long been a traditional buyer of gold. But I think also the geopolitical situation remains unnerving, to say the least. And so I think that's also helped gold.
It certainly has. Naresh, can I bring you in this conversation as well?
Absolutely.
Again, you know, we didn't plan this, but your reasons and Dr. Yardeni's reasons almost resonated back then. I wonder if you think there are added factors to gold. We'll come to silver as well, but let's start with gold.
So something still more important has happened in the last, I would say, 3 months. In September, Morgan Stanley CIO recommended a, believe me or not, 20% allocation to gold. And Goldman Sachs last week assessed that combined gold allocation by all US investors is 21 bips. And so you can see the contrast. And so I think central banks drove or started the rally, but there are other legs which are emerging. And outside India, gold is actually under-owned. Indians own a lot of gold, but rest of the world, I think the allocations are in bips, not in percentages. And markets and investors are understanding the role of gold as a diversifier, as a hedge, and also due to the reckless policies which US is undertaking. And hence, I think there are more legs which have emerged and the rally continues.
Yeah, one of the points that you mentioned in your presentation to me as well, Naresh, is that central banks don't just want an allocation, they want to own gold. You reckon what we've seen in 2025 is a, if not a teaser, but something that will get repeated in 2026 and beyond from the central banking perspective?
So central banks, before that, we spoke about central banks possibly not reporting their full purchases.
Yeah.
So Financial Times a month back or two back took out a report and actually agreed to that a lot of central bank purchases are not being reported. Having said that, the pace of central bank buying in 25 has been little lower than the previous 3 years.
Okay.
From about 1,000 tons a year, it's about 800-900 tons. So I think the primary driver now could be the large portfolios, the financial institutions, the non-India HNIs, family offices, which are coming on board and understanding the role of gold. Central banks are continuing to buy. By the way, central banks were net sellers of gold between 1988 and 2008. For a full 20 years, every year central banks de-hoarded gold. And the last point is not only having gold allocation, central banks are wanting control of the gold. For example, India has got more than 300 tons of its gold in the last 5 years back on shore, onto its vaults. That's also a geopolitical risk central banks are not wanting to take. So overall, yeah, I think the role of gold as a strategic asset, as a diversifier, as a hedge is looking increasingly strong.
Yeah, and I think as both you and Dr. Yardeni will say that the buying of central banks in 2025, the 800, 900 tons is the disclosed one. Whatever has not been disclosed might be something completely different. Dr. Yardeni, Naresh made an important point which I would want you to dwell on, that Indians may hold a lot of gold, but globally gold is not that well owned from a retail investor's perspective, if I can classify that loosely. Do you see that changing, and can that have a material impact on gold price movement?
Yeah, well, I think you made an excellent point about that. Gold is under-owned around the world. And I think the reason for that is in most of the major countries with major stock markets, most of the action has been in the stock market. That's where the interest has been. And I think when you look at asset classes, investors generally have looked at stocks, bonds, and occasionally commodities, and very, very rarely looked at gold. And gold was sort of asleep there for quite some time. It was a real sleeper. And then I noticed in 2024 that it broke out to a new high above 2,000. That's when I turned bullish on gold. And when it got up to 3,000 at the beginning of this year, I looked at the charts. I said, look, I think this could go to 4,000. And I think now that it could get to 6,000 by the end of this year, and 10,000 by the end of the decade, by 2029. And, the problem with gold is it's kind of like Bitcoin in the sense that it's got no earnings, it's got no interest, it's very hard to value, and it is sort of a psychological asset in terms of uncertainty and risk-off characteristics. But I have noticed that there's a pretty interesting relationship between the S&P 500 and gold. If you put them on the same chart, you'll see that they're inversely related, which means that gold is, in fact, a very good diversifier for a stock portfolio. You get less volatility in your overall portfolio. But what's fascinating is that the long-term trend seems to be almost the same. And I can give you some pretty good fundamental reasons why the S&P 500 should get to 10,000 by the end of the decade. And if that happens, I think gold, sort of from a portfolio balancing view, can very well get to $10,000.
So, Dr. Yardeni, and just one quick follow-up. So, I heard you say 6,000 by the end of this year and 10,000 by the end of this decade, right?
Correct.
So that's a substantial uptick from your view that you held 9 months ago. The question that I have is, so the question that I have is, does the central banking policy, if Fed were to loosen a bit more because of political reasons or otherwise, does that have any bearing negatively on gold prices?
Well, I mean, there's always possible surprises here. I mean, I presume that if gold really exploded the way Bitcoin did, that President Trump would see that as a great opportunity to say, hey, we really don't have a federal deficit anymore because our gold is worth so much. And suddenly people would start to worry that the United States might actually sell gold as a way to reduce its debt outstanding. So there are sort of kind of out there scenarios that we don't want to completely ignore with all the excitement here. We just recently saw a decent correction in both silver and gold on margin increases, which for some reason the market didn't anticipate, but should have. So we do want to be on guard here. But I think the fundamental demand-supply situation remains quite bullish for the precious metals complex completely, not just for gold, but silver, platinum, palladium. And I think there is sort of a nervousness about excessively stimulative monetary and fiscal policies around the world, potential debt crises around the world. I mean, Japan has a debt crisis right now with what's going on in their bond market. The UK has a sort of a debt crisis. And so it's very likely that investors in Japan and the United Kingdom are suddenly realizing that they don't own enough gold.
I heard some troubling numbers for France as well. But Naresh, coming on these factors and beyond just this, I mean, I think Dr. Yardeni made an important point. It's not just gold, by the way. The last 1 month of calendar year 25 saw silver come into a lot more limelight than gold, right? So one is gold, and how can people play that? But two, some of the other precious metals, because you must be invested in maybe some of them or maybe just a couple of them. How do investors get access to this? Is it via ETFs or are there some other means as well? But of course, give your view as well, by the way, on gold and silver.
Gold, of course, in gold we have, apart from the regular ETFs or sovereign gold bonds, which are traded on NSE and BSE, you could also play via gold financiers. That's a very unique play India has because Indians have a lot of gold. And by the way, compared to a credit growth of about 10-12% for India as a system, gold loan growth in the last 1 year is 100%. So there's clearly benefit, tailwinds for gold loan companies from rising gold prices and also relaxed regulations. And silver, of course, you have silver ETFs. On silver, gold is, I would say, I'm saying that it's probably structurally under-owned. I can't say that for silver. So silver today is about 70% over its 200 DMA, if people who are inclined technically. So it is stretched, and people who are giving reasons for silver's rise, the same reasons existed 3-4 months back when silver was probably half of or 30% lower. There's just one important development which I'm researching, I don't have conclusive view, is news that Samsung is building a silver-based battery with a 600-mile range. And apparently, if that comes through, then that takes up 30, 40, 50% of annual silver production.
Wow.
So I'm still on various AI engines and trying to make sure that that's real. Even if it comes a few years later. But otherwise, silver looks a little stretched to me. In the last 20 years, whenever it's gone 60, 70, 80% above its range, 200 DMA, I think it's struggled or consolidated.
Okay. But what's your gold thesis then? Dr. Yardeni is saying 6,000 by the end of the year, 9,000 or 10,000 by the end of the decade. Are you in the same camp?
So last time you had probed me on what the targets are. I said I don't give a target, but what I mentioned was it will surprise the most bullish estimates. I think the bull market is very much on. It looks very, very solidly behaving. There are small corrections. Corrections are being bought in. And it's very different from the previous bull market when central bankers were sellers in the first 7 years of the bull market. And it's now the real big money, which is the non-central bank portfolios. Like, for example, Morgan Stanley CIO recommended a 20% allocation. Morgan Stanley wealth AUM is $7 trillion alone. So there are just real big money which are underexposed to gold. And I'm reasonably sure they will look at it, as even Dr. Yardeni mentioned, as a diversifier or as a hedge, and not just for returns. So, not just the past returns. So, I think it looks well placed. It may consolidate because they've all run up too fast. I would personally not buy now because I've allocated earlier, but I don't feel like it's the end of the bull run.
Okay, Dr. Yardeni, final question to you. For somebody who has missed out on this, the question therefore would be, if there is a pullback into gold prices, how likely is that? And is that a pullback something to be used? I presume your answer is a yes, but I still want to hear it from you.
Yeah. Well, I think I agree that silver is stretched for sure, and it's the old saying that the best cure for high oil prices is high oil prices. Well, I think the same can be said for other commodities, particularly silver. At these prices, there's tremendous incentive to sell the silver forks and knives that we have at home, and there's a tremendous incentive for people to mine more silver. So I wouldn't be surprised if silver does have a pretty significant correction, much more so than what it had a few days ago. And what will be very interesting to see is how gold reacts. And I won't be surprised if gold actually holds up reasonably well. But yeah, I think the gold market has in fact demonstrated a tremendous amount of stability in this bull market, in the sense that sell-offs are bought, and there seems to be a substantial amount of money looking to get in. So I would say, at this point, buying in the dips still makes sense to me, and I think there's still plenty of upside in the gold market.
We are at 4,300 if indeed the prediction is 10,000 in 4 years' time. I see no reason why the dip shouldn't be bought. Dr. Yardeni is so correct. But, well, both of you, viewers, I hope you got a sense of the reasons behind the continued optimism that both our experts have. And I hope it helps you in some fashion in your overall portfolio allocation, whatever part precious metals play in that. But Dr. Yardeni, Naresh Kataria, gentlemen, thank you so much for taking the time out and being with us today on the show. Really appreciate your time.
Real pleasure.
Thank you, Naresh. Thank you.
Thank you, Dr. Yardeni.